U.S. economy faces dual realities, strength meets shutdown risks. The U.S. economy is at a critical juncture, balancing robust growth and the promise of an economic nirvana against the looming threat of a government shutdown. Recent analyses from investing.com highlight this duality, with one article noting stable inflation and the Federal Reserve's shift toward labor market concerns, while another underscores strong economic momentum tempered by political risks. Together, these insights paint a complex picture of an economy on the cusp of prosperity but vulnerable to disruption. Inflation stabilizes as Fed focuses on labor market. According to the article, inflation holds steady as Fed turns to labor market. Inflation in August 2025 remained steady, with the Core Personal Consumption Expenditures (PCE) index, a key metric for the Federal Reserve, rising 0.23% month-over-month, consistent with July's figures. On an annual basis, core PCE stood at 2.9%, above the Fed's 2% target, but within a narrow 2.6 to 3.2% range observed since late 2023. Overall inflation rose 0.3% monthly and 2.7% annually, with services inflation showing persistent strength at 0.32% month-over-month. The article notes that controlling inflation's final stretch remains challenging, stating, "We have consistently said that the last leg of getting inflation under control will be the toughest." However, the Fed's attention is shifting from inflation to the labor market. Federal Reserve Chairman Jerome Powell, in the September 17, 2025 meeting, expressed concerns about a softening labor market, stating, "You have an environment with low layoffs and low hiring. The concern is that if layoffs start, there won't be much hiring for those laid off, which could quickly lead to higher unemployment." Initial jobless claims for the week ending September 20th dropped to 218,000, down 14,000 from the prior week, signaling low layoffs but a broader trend of labor market softening. Powell further noted, "In this low dynamic, somewhat soft labor market, downside risks to employment have increased, while near-term inflation risks are tilted upward." The second quarter GDP growth of 3.8%, exceeding expectations, has raised concerns among investors that the Fed might delay rate cuts. However, the article suggests that the Fed's focus on employment risks could pave the way for looser monetary policy, potentially supporting markets. Investors are advised to closely monitor upcoming employment reports, as these will heavily influence the Fed's next moves. Economic nirvana in sight, but shutdown looms. The companion article, "Probable Shutdown Adds Risk While U.S. Economy Nears Economic Nirvana," paints an optimistic picture of the economy's trajectory. The Atlanta Fed's GDPNow index estimates current growth at 3.9% annually, with projections of up to 5% in 2026, driven by onshoring efforts boosting GDP. Strong durable goods orders and an improved ISM manufacturing index signal economic resilience, while the upcoming September payrolls report is expected to be robust, unless delayed by a government shutdown. Consumer confidence, however, shows cracks. The Conference Board reported a decline to 94.2 in September, from 97.8 in August, the lowest since April 2025. The Present Situation Index fell to 125.4 from 132.4, and the Expectations Index dipped to 73.4 from 74.7, reflecting mixed consumer sentiment. Despite this, consumer spending continues to outpace income, supporting economic momentum. The specter of a government shutdown, however, introduces significant uncertainty. Vice President J.D. Vance highlighted disagreements over healthcare provisions for undocumented immigrants and low-income citizens, with Democrats pushing to roll back tax reforms, an unlikely prospect. President Trump has threatened to fire federal employees en masse if a shutdown occurs, escalating political tensions. Such a shutdown could disrupt critical economic data releases, including payroll reports, and dampen investor confidence. Fed's policy and market implications. The Fed faces a delicate balancing act, with deflationary pressures from Chinese imports and a strong U.S. dollar reducing inflation risks. The Fed has room to lower interest rates to support sectors like housing. The article suggests this could usher in an economic nirvana, a state of low inflation, strong growth, and increased money velocity fostering widespread prosperity. This environment sets the stage for a potential year-end market rally, provided political disruptions are contained. For investors, the outlook is cautiously optimistic. The economy's fundamentals are strong, But the threat of a shutdown and its ripple effects on data releases, consumer sentiment, and market stability cannot be ignored. Monitoring political developments and employment data will be crucial in navigating this period. The U.S. economy is at a crossroads, with strong growth and stabilizing inflation pointing toward a bright future. Yet political risks like a government shutdown could derail progress. The Fed's pivot to labor market concerns signals potential policy easing, which could bolster markets, but investors must remain vigilant. As the economy nears Nirvana, its resilience will be tested by the interplay of economic strength and political uncertainty.